A single sentence can actually kill your mortgage approval. Not because you're lying to your bank, not because you cannot afford that home, but because the way you actually said it and created that red flag that your lender cannot now close their eyes and totally ignore. In this video, I'm going to show you 10 things you should never say to your bank when you're getting your mortgage in Canada and exactly what to say instead. Because in the mortgages, wording is not just important, it's actually absolutely everything. Quick disclaimer before we even start. This is not about you lying to your bank. I work for Scotiabank. This video is about phrases people say casually that create those red flags, slow your files down, or weaken your approval. Because in the mortgages, wording and paperwork actually matters. A mortgage approval is basically your story plus a proof. If your story and your documents do not match, even by accident, it can turn into the delays, it can turn into extra conditions, or totally deals falling apart. Let's go through the 10 things you should never say and what to say instead. Number one, occupancy. Do not say it's my primary residency if you are not actually sure you are going to live in there. That one sentence changes lots of rules. It will change the pricing of the mortgage and the risk. Primary residency mortgages have different rates and requirements that rentals or investment properties do. And if you say it's your primary home, but the lender finds out later it's not, that can become a mortgage fraud, even if you didn't mean it in that way. Say this instead: I plan to live in it as my primary home, or I am deciding between living there or renting it out. What changes if it's actually a rental? This keeps you honest and it lets your lender structure the file properly from the beginning. Okay, number two, the give down payment trap. Don't say it's a gift, but I will pay them back later. A gift is supposed to be non repayable. That's the whole point. If you are planning to pay it back, that's actually not the gift anymore. That is a loan, and the loans affect your debt ratio, which actually affects how much money you can approve for. If the lender finds out later that you are paying it back, that actually can be a huge problem. Say this instead: it's a true gift and I don't have to repay it. Or if the part of the down payment is borrowed, how does that actually affect my approval? If it's borrowed, your lender needs to know upfront so they can factor it into the debt calculation. It might lower your approval amount actually, but at least your approval will hold. Okay, now let's talk about a very tricky one is the cash deposit. Here's the thing, you cannot just deposit the cash and it's going to be absolutely fine. Cash with no paper trails create questions and slows everything down. Where did it come from? Can you prove your sources? Is it from you? Is it legitimate? Where the money is coming from? Lenders have to follow anti-money laundering rules. If they cannot trace your down payment, actually, they cannot approve your mortgage. So here, what to say instead. Here is the sources of all the funds, and here is the statements that show the full trail. If you have cash deposited early months before you apply, and be ready to explain where it came from with documentations. All right, so let's focus right now on the income. Things like I make about X amount of dollars, especially if you are hourly, commissions, bonus, overtime, or self-employed. Lenders do not use about. They use what your documents actually support. If you say you make $80,000, but your documents actually show 65,000, and that's how much you're declaring to share. Now we have a gap, and that gap actually creates the problem. So I've seen buyers get pre-approved based on what they thought they made. And then during the final underwriting, their qualification income was actually much lower. Make sure that your income is salary, hourly, commission, self-employed is based on documents. And the income figures you actually use can be supported by documents. So this forces the math to be done upfront, so there is no surprises later. Another thing is just approve me for the maximum. Max approval and the comfortable payments are actually not the same things. Just because you can qualify for, let's say, $700,000 doesn't mean you should actually take the whole $7,000 and spend it. What if rates goes up at renewal? What if you lose your job? What if you want kids or you need to take some time off work? Your lender's job is to approve you for the maximum amount of money. Your job is to decide what you actually can approve. Ask to see what's your maximum amount, but also make sure that you know what's your payment range that you feel safe in. That gives you an option and ended to protect you from overextending yourself just because the bank said you can borrow it. Now, this is our next one, and it's probably the most dangerous one because most people think once they are pre approved, they're done. But that's not how this whole mortgage process actually works. Pre approval is not the finish line. Final approval is still depends on conditions. It actually depends on your documents. It depends on you staying consistent and often on the property itself. If anything changes, if your job changes, if your debt changes, your down payment sources changes, your approval can change right on the way. So ask your lender, what could change my approval between now and the closing? That forces your lender to explain the conditions and what to avoid while you're actually shopping around or you're waiting for the closing. The next one, please don't guess on down payment rules. Don't say to yourself, I cannot do less than 20% down payment, no matter the. So the minimum down payment changes depending on your purchase price. And in certain prices point, you actually will have to pay this 20%. So if you're shopping for, let's say, $1.5 million home, thinking you only can put 10% down payment, you're going to have a problem. So say instead, here is my purchase price. What down payment rules apply on this deal? This makes sure you're shopping in the right price range from the beginning. Okay, a critical one, your job changes. Don't say I'm switching jobs next month, but it's basically the exact same job. Sometimes, yes, that is fine. Sometimes it changes how your income is actually counted. If you're going from a salary to commission or permanent job to a contract, that matters tremendously to the lender. Even it's more money, the structure is extremely important. So say instead, I may change jobs. If I do, what would you need so it doesn't affect my approval? That way, if you do switch job, you know exactly what documents you need so your approval does not get delayed or actually approved. Okay, new credit. That's our next one. Do not say I'm going to open a new line of credit. I am buying a car while you're shopping for a home. New debt can reduce your approval amount or change your file right before the closing. I've seen buyers lose deals because they financed a car 2 weeks before the closings and the lender repulled the credit, saw the new debt, and the approval got pulled. So say instead, should I avoid a new credit until after closing? Will it make a difference? The answer is almost always yes. Stay boring until you have your keys from your home. And the next one, that debt is not important. Please don't say those sentences. If the debt exists, the lender needs to account for it. Missing or stating information can create big problems. I have had clients forget the $300 monthly payment on their alimony or child support, and it pushes their debt ratio over the limit. So say instead, here's every debt and the monthly payment tells me what counts and what does not. That way, your lender can calculate your approval accurately from the beginning. Now, what if you already said one of the things? If you are watching this thinking, oh, I already said that, don't panic. Most of the time, it's fixable, but you want to fix it as fast as possible. Here, what you should do. Please tell your lender immediately, not your realtor, not your friend. Go directly to your mortgage broker. Because the earlier it's corrected, the easier it is to clean up. This is what you said. Here is what is true. Here is the documents. What do you need from me to make this clean? And here is the most important thing. Once you are pre-approved, stay boring, no new debt, no missed payments, no big transfers, no major job changes, unless you talk to your lender first. Because most mortgage problems, they happen because people make changes in the middle and the lender finds out too late. Bottom line, be honest and be precise. If your lender is not asking detailed questions, that's not a great sign. A strong mortgage file is built on clean answers and clean documents.